Hey everyone, Coach Investor back on our earnings video for today. So, third big earnings week. So, what companies are we going to look out for? Which company am I looking closely at? Of course, some of these companies I own personally in my portfolio. And yes, we're going to try and cover most of them throughout the week. So, on Monday, before the market opens, big ones. Berkshire Hathaway, Brookfield Asset Management before the market opens. Then after the close, we have for the dividend investors, Realty Income has not been that great recently. We have Hims and Hers. I'll be looking out for that. Clover for those that are still with the Chamat SPAC stocks. And then on Tuesday, before the market opens, a couple of interesting companies as well. Uber, Celsius, Datadog. I think those are the ones I'll be watching. After the market closes, Rivian, Upstart, we have Axon, Dutch Bros, and Toast. And I believe we also have Robinhood during that day. I'll try and do a live stream on the channel. If you're interested in that, let me know down in the comments below. Then on Wednesday, we have Roblox before the market opens, Warner Bros, Fisker, Under Armour, for those that are interested in that. I'll be looking out for Roblox. After the market close, of course, AMC for everyone on Reddit. Then we have Walt Disney. This is going to be a big one, very important quarter for the company, especially for the stock that had not been doing very well. This is a company that we will be watching very, very closely. TWLO, Affirm, Duolingo as well. Then on Thursday, before the market opens, Li Auto at first, then Oatly, Fiverr, which is one I'll be watching very, very closely. I own it personally. I'm down quite a lot on that stock. Then after the market close, Plug, Unity, The Trade Desk. Unity and The Trade Desk are companies that I own personally in my portfolio. Those are ones I will be watching very, very closely. Win for the Las Vegas people. Casinos have been doing okay, I think, recently. I haven't really been watching those stocks, but I think that could be interesting. Then the rest, you have some cannabis companies as well. And then on Friday, companies nobody is really looking at, unfortunately. So in this video, I want to cover Hims and Hers, Walt Disney, Unity, Trade Desk, and Fiverr. We're going to have a look at the state of the stock right now, the expectations for the upcoming quarter, and then the graph. Of course, if you enjoy this type of videos, leave it a thumbs up, subscribe. If not, would really appreciate that. If you want to support me even further, do check out the link down in the description and in the pinned comment to get the top 10 best stocks to buy now, or go to full.com/couchinvestor. Thank you very much. So at first we have Hims and Hers. Currently the stock is trading at $6.48. Market cap $1.37 billion. Forward PE 32.1 times. So yeah, not that much for a company that is growing quite fast year over year, but I'll explain a bit more later on. You can clearly see here the trend with regards to revenue. Yes, over the last 2-3 years, revenue has been going up and up. Of course, quarter over quarter, growth has been a bit stagnant. With regards to free cash flow, in the last 2 quarters, free cash flow is positive, return on equity is improving, gross profit margin above 80%, and return on capital is also improving, still negative though, negative 9.5%. If you want to look at some valuation metrics, well, price to earnings, EV to EBITDA, price to sales in the next 12 months compared to its mean, well, we don't really have that much to look at, but hey, it is much cheaper than before. And so if we look at Hims and Hers last quarterly earnings, revenue was $207.9 million. That increased 83% year over year, with the biggest increase here in online revenue. Now, of course, if you look at the expectations for the third quarter, they expect revenue of $217 to $222 million. So quarter over quarter, it's not that big of an increase. But what did you expect a company to continue to grow 83% year over year, especially right now? I don't think so. But if we look at net loss, that was just $7.2 million, huge improvements year over year. Gross margin 82%, last year, same quarter, 77%. Adjusted EBITDA was $10.6 million compared to a loss of $7.5 million, same quarter last year. Then for the third quarter, the expectations are adjusted EBITDA of $10 to $13 million, reflecting adjusted EBITDA margin of between 5 to 6%. And then for the full year, they expect revenue to be between $830 and $850 million, adjusted EBITDA of $35 to $40 million, representing approximately the same margin as before, 4 to 5%. Now, of course, we can dive even deeper, but I already did a video specifically talking about Hims and Hers. If you missed that, it's going to be in the top right corner. And so if we look at the graph right now, under $6, there has been, of course, last week, a big green candle that has been bought $6 could be a good support line and good buying area, but still there's a long way to go from when we came from. That doesn't mean that we have to go back to $12 or so, but even this resistance point right here, which is around $7.20 or so, is going to be important, especially after the earnings report, which in my opinion will be again a pretty good one. Up next, company number 2 I'm watching very closely is a company that I do not own in my portfolio, not even in the trading one, and that's Walt Disney. Now, Disney is trading at $85, market cap $155.66 billion, forward PE 19.6 times. Year to date, it's basically flat-ish. It's only down 2% right now. Now, if we look at the valuation with regards to its 5-year mean, we are, of course, much lower, but the business has been going through some struggles, let's call it. So PE, EV to EBITDA, price to sales, price to free cash flow, all beneath the 5-year mean by quite a margin actually. But of course, things have not been looking that rosy at all for Disney, especially if you look at gross profit margin that has previously been at around 40% or so, high 30%, but since then it has been crushed, of course, because of Disney Plus, their switch from linear to streaming, which of course this is the result. Return on capital is now 3%, return on equity 2.72%. Yes, we had 2 quarters now in a row of positive free cash flow. Usually it is positive free cash flow, and we might actually get a big bump if this deal goes through. So Disney nears deal to sell $10 billion valued India business to Reliance. Of course, this will put a lot of cash into Disney, whether they would like to pay down their debt or invest even more, or just keep it at cash, remains to be seen. Now, with regards to last quarter, of course, as always, parks are pulling here the most work. So that was up 13% year over year, whereas Disney Media and Entertainment Distribution is down just 1%. Then as for operating income, that segment is also down 18% year over year, while parks are up 11%. There have been some talks, of course, that there is a slowdown in parks, too expensive, lines aren't that long, etc., etc. But of course, since we had the summer holidays in that Q3, then maybe you might see some positive effects in there. Of course, a lot of eyes will be on the amount of paid subscribers. Is it still going down? Is it finally going up? What's happening there? So we're going to keep an eye on those numbers right here, and hopefully they won't remove any of these numbers anymore. And of course, the average monthly revenue per paid subscriber, you would like that number to increase. I mean, we've had some positive comments with regards to other streaming players, the advertising markets, so maybe you might get some positive momentum for this business as well. Now, I wanted to show you this again because this went probably under the radar last quarter. With regards to parks and experiences, the revenue there internationally grew 94%. Of course, that now compared to last year, most if not all parks around the world for Disney are now operating at full capacity. This is usually the result. And so, yes, I do think that we're going to see a more positive reaction when it comes to operating income as well. Then with regards to the expectations, expectations are that revenue increase 6.2% year over year, but down 4% quarter over quarter. And with regards to EPS, that should be up 137% year over year, but down 31% quarter over quarter. And of course, if you need a small reminder, the dividend is coming back. Not a lot, but still a dividend. Then with regards to the graph, still my scribbles here are working perfectly. $85 seem to be really an area where people are comfortable buying, or $85 is a comfortable area to buy. It seems so. RSI is now back into a more neutral stance. Of course, we had a great end of the week last week. So that's the green reaction you see here, back over the 20 and the 50-day moving average. Still a long way from the 200, which is at $90 or so. Next company I'm watching is Unity. So Unity trading at $27.64. It really feels like it's been trading at that price for a long time. Market cap just over $10 billion, forward PE 33 times. Year to date, it's down 3.32%. If you look at PE, next 12 months, EV to EBITDA, price to sales, it's all less, it's lower than its 3-year mean. And PE by quite a lot, of course. There was that merger, so that positive impact is impacting the business as well, which will impact the numbers that you're seeing in the quarterly earnings as well. Which you can see right here, pro forma basically takes into the effect of the ironSource merger. Then with regards to guidance, so they say here they became profitable on an adjusted EBITDA basis in the fourth quarter of 2022 and have been building margins since then. We were free cash flow positive in the second quarter of 2023 and plan to build margins from here. Our next milestone is to become profitable on a GAAP basis. They say here that they expect third quarter revenue of around $445 million, an increase of between 67 to 70% year over year, and 7 to 9% on a pro forma basis. They're also guiding adjusted EBITDA to $90 to $100 million. As for the full year revenue, they see it increase the low end of the revenue guide by $40 million to $2.12 to $2.2 billion, an increase of 52 to 58% year over year, or 5 to 9% on a pro forma basis. We are guiding adjusted EBITDA to $320 to $340 million. That's up from the prior guide of $250 to $300 million. And they continue to be committed to reach $1 billion in adjusted EBITDA run rate by the end of 2024. And of course, with Unity, there was this whole scandal not so long ago that impacted the business, as you can see right here. Remains to be seen what happens there. I mean, how big the impact actually was, but currently we are back at a price that was previously a support line quite a few times actually throughout this year. So yeah, I mean, this earnings is probably very, very crucial for the stock, since previously that was a support line. You don't want this to turn into a sort of resistance. Next up is Fiverr. Now, Fiverr trades at $22.22, forward PE of 11.7 times. That's pretty low. Market cap $852 million. Year to date, it's down 23.75%. If you look at the valuation, well, it's really a joke compared to its 3-year mean. Might be because previously they were growing extremely fast, and so they got a premium valuation, and now they're not growing that fast anymore, but they are becoming more profitable. And so, yeah, you're seeing that huge difference here in PE in the next 12 months, that is. Now, if you look at the trends, revenue, of course, in the last couple of years have grown, but then have stagnated a little bit in the last couple of quarters. Free cash flow positive for a long, long time, and now increasing. Return on equity is becoming better, still negative 6.19%. Gross profit margin have come down since the peak at the pandemic, but are improving as well, and so is return on capital. Because if you remember, of course, revenue growth is not that much compared to what we were used to, so it was only 5.1% year over year, but GAAP net income is positive, adjusted EBITDA is higher than before, adjusted EBITDA margin is increasing as well, take rate still extremely high, 30.7% there. And as for financial outlook, look, revenue, this is not a high growth company anymore with regards to the top line. They expect between 8 and 12% growth year over year, and for the full year, just 7% at the midpoint. But adjusted EBITDA, if you look at their prior guidance, which by the way was revised a couple of times, for Q3 between $14.5 and $16.5 million for that quarter, which is an increase quarter over quarter, a bit at the midpoint. Then for the fiscal year, they expect $56 to $60 million. That's up from $48 to $56 million. So again, they are now, because of the post-pandemic era, they focused a lot on becoming more and more profitable while also trying to grow the business, but becoming more and more profitable is definitely what we're seeing right now. And so if we look at the graph, I had to zoom out quite a lot to find that point right here where we're back at the March 2020 lows. Of course, then the stock got a huge bump because, well, growth was just incredible, but not that profitable as it is today. So you might say, yeah, you might be getting a bargain today if you are a believer in the creator economy, in the freelance economy, and stuff like that. Then yes, you're probably getting a bargain right here, a company that will be growing more and more in the future because total addressable market, it's still pretty big, but is much more profitable than before. So remains to be seen what they print in the next coming days. Up next, last company I want to touch on in this video is The Trade Desk. It's currently trading at $79, market cap of $38.76 billion, forward PE 61 times. Yes, very, very expensive. It has always been very, very expensive. Year to date, it's up 76.4%. And as you can see here, the trend for the business with regards to revenue has been up and up and up. Free cash flow has been positive for quite a while. Return on equity is now 6.7%. Gross profit margin around the 80% mark. Return on capital 4.21%. And if we look at the valuations of this stock, well, currently it is lower than a 3-year mean. Now that said, yes, like I said at the start, it is trading at a premium. It has always been trading at a premium because it is a quality company with great management and in a growing market. So this is usually the result. But yeah, if you bought late last year, it was trading at 37.6 times, which back then people were still saying, oh, it is very expensive. So last quarter, they reported revenue of $464 million that increased 23% year over year with a net income of $33 million and GAAP diluted share of 7 cents. Now, what do they expect now? They expect revenue of at least, always at least, $485 million and adjusted EBITDA of approximately $185 million. And of course, listening to what most advertising companies that have already reported said, the big ones, I do expect this to be another good quarter from the trade desk, but I believe everyone wants to hear what they have to say about guidance. Do they see a reacceleration? What's going to happen in Q4? Q4 holiday season usually get some better numbers anyways, but hey, this will be interesting to see, but I do expect them to again beat their own expectations. And so if we look at the graph right now, I mean, the stock has gone up like we've seen before quite a lot this year. We had that little dip in the last coming weeks under the 200-day moving average, but then last week, big green candle above the 2050 and the 200. RSI still pretty neutral. Yes, maybe 85 will again be a sort of resistance point as it has been a couple of times in the past. So overall, these are the companies I'm watching closely. Of course, some of them I own personally in my portfolio, but I'll cover a lot of other companies throughout this week as well. Roblox, the Rivians, the Robinhoods, things like that. I'll try and cover most of them on the channel. Of course, do write in the comments which companies you own are reporting. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, and I'll see you all in the next one. Bye-bye.